Dear viewers, in this video I am going to share important points to remember for building a profitable equity portfolio. If you want to listen my videos in Bengali, then visit here. This is my Bengali channel. Bangla সমস্ত শেয়ার মার্কেটের ভিডিও আপনি এই চ্যানেলে পেয়ে যাবেন. I am Prashanjit Paul, author of the best-selling book How to Avoid Loss and Earn Consistently in the Stock Market and actively investing in the stock market since 2010 and also achieved financial freedom. So, let's start. Suppose in your portfolio there are 10 stocks. Out of those 10 stocks, 5 are in profit and 5 are in loss. Now, all on a sudden, you require some money to withdraw from your stocks portfolio and you may need to sell 5 stocks from your 10 stocks portfolio. Now the question is, which 5 stocks you will sell? Those are in profit or those are in loss? Maximum time what I noticed is investors eager to sell those stocks are in profit and keep holding the losers. What I mean to say, that maximum investors that I have interacted, I have noticed that many eager to sell their winners if there is some profit on a particular stock, and they stay with losers in the hope that once those stocks will turn profit, then only I will sell. See, this is a very costly mistake. Selling winners and staying with losers can be a very costly mistake. I'll explain it. See, while a stock price over a period of 1 year or 6 months, if a stock price moves from 100 rupees to 150 rupees, there must be some positive reasons for that. And while the positive reasons remain, most likely from 150 level the stock price might move up to 160, 70, 80 or even 200 or even higher than that. Similarly, while a stock price drops from 100 rupees to 50 rupees, there must be some strong bad reasons. Without a bad reasons over a period of 6 months or 1 year time, a stock can't drop from 100 to 50 rupees. And if that bad reasons remains, most of the time it's not likely that this bad reasons changes overnight. Maximum time that bad reasons remains, and if that's the case, then from 100 to 50 the stock price might fall, from 50 to 40, 30 or even go below that. So my point is, just because a stock price corrects from 100 rupees to 50 rupees doesn't necessarily mean that it will move up from 50 to 100. Rather, there is a possibility that from 50 also it can go below to 30, 20 or whatever. So if you attempt to sell your winners and stay with your losers, then what will happen? You will restrict the upside, rather widen your downside. That happens with many stocks. There are many examples I can offer you. If you are in the stock market for 5 years, 6 years, 10 years, then I am sure you can correlate with it. You must have suffered from some similar incident. So the point is, the first thing that you need to remember, that while you construct a portfolio, while you need to sell the shares, always first focus on losers. It's important to cut down your losers as early as possible and staying with your winners as long as possible. In fact, maximum successful investors, the big investors, be it Rakesh Jhunjhunwala, Vijay Kedia, Ramesh Damani, all they follow the same principle, staying with their winners over a longer period of time and cutting their losers. So remember that it can be a very costly mistake if you quickly book profit from the winners and stay with your losers. The second lesson, don't average in downside. I will explain. I have noticed that many investors, say for example, have purchased a stock at 100 rupees. Now the stock price dropped from 100 rupees to 80 rupees and then from 70 rupees. So the investor might thought, okay, it came down to 70 rupees. If I purchase more, then my average price will come down so that I can have a recovery chance much better than earlier. Further, if the stock price further crashed to 50, then they might purchase more. See, this is also a very costly mistake, because if you keep averaging on the downside, what will happen? Your average cost price will surely reduce. In percentage terms, your loss will reduce, but in absolute terms, your loss will actually widen, because as I mentioned earlier, if you noticed a stock price drops from 100 rupees to 50 rupees over a period of time, be it 6 months, 7 months, 1 year or whatever a period of time, there must be some strong reasons. Without strong reason, a stock price never corrects by 50% or similar like that. So most likely the reasons remains and the stock price drops further from 50, 40, 30 or might remain in this 50 kind of range over a longer period. So suppose you have purchased one stock at 100 rupees and now it came down to 50 rupees. You did nothing. So this is the case 1. And in the second case, you purchased one stock at 100, it came down to 50, and you again purchased another one stock at 50 rupees. And now the stock price came down to 40. So in first case, your absolute, in percentage term, your loss will be 50%. Your absolute terms also the loss will be 50 rupees. But in the second case, if you again purchase a stock at 50 rupees, what will happen? Your average, the total 2 per stock you purchased, it will become the total average buy price of 150 rupees. Your average purchase price will go down, but once the stock price comes down to 40 rupees, in percentage terms the loss will be around 46% kind of, but in absolute term the loss will be 70. So although in percentage terms it is looking a less loss, but actually averaging your losers means most likely you are widening your loss. On the contrary, maximum successful investors, if you notice, they keep averaging on the upside. It means if a stock price is today at 100 rupees and then it moves up to 150 with some solid reasons. I'm not talking about any speculative movement. It's like I'm not talking about if within 1 week the stock price jump to 100 to 150, or in 1 week stock price drops to 100 to 80, 70. I'm not talking about this kind of movement. Rather, I'm talking about over a longer period movement, at least 6 months movement, 7 months or 1 year kind of movement. So if a stock price moves from 100 to 150, or if 100 to 200 rupees, there must be some strong reasons, and if such reasons, or if the fundamentals of the company keep improving, then there's a lot of chance from 200 rupees also the price might go to 300, 400 or whatever in the upside. Don't think that just because in the past the stock already provided double return, it can't move further from there. Or don't think that the stock price already dropped by 50%, it means it must go back on your buying range. It's not like that. So remember, it's a very costly mistake to averaging out your losers. Never ever average your losers unless and until you are 100% sure that the price must recover. In most of the cases, what happens, the recovery takes longer time. So it's always better while you construct your portfolio, don't average your losers, or don't average while the stock is in free fall. The third important point, diversify your portfolio. Now, what do you mean by diversification? What is the difference between over diversification? How many stocks you actually hold in your portfolio? So all this question, before answering this, I have an important announcement for you. Recently, I have introduced YouTube membership option where every month I share a fundamentally strong quality stock handpicked by me. In recent stock, the February 21 stock is doing very good in the market despite volatility, ups and downs in the market. So if you want to receive fundamentally strong quality stock from me, you can check out the YouTube membership. Under any of my video, you will find in the description box there's a join option. If you click on the join, you will find there are 3 packages. The package starts from 399, then 599 and then 3599 with an introductory video. If you like, you can join in any of the membership. And yes, these are the monthly commitments, so you need to pay for only 1 month. If you don't like, you can cancel at any time. So now let's move back to our discussion. Diversify your portfolio. See, there's a very thin line between diversification and over diversification. If an investor is holding 40, 50 kind of stocks, then that's not called diversification. That is actually over diversification. So the question obviously comes, what is the good number of stocks that you can hold in your portfolio that you can say are fair stocks? See, it varies from person to person. It simply depends on how many stocks you can track actively. If you are an investor who have some different full-time job, you can't afford much time into the stock market, then I will say 10 to 12 stocks is fine, because you may not actively track more than 10 to 12 stocks. But if you are following someone else's advice, or someone else is actively tracking your stocks, or if you are a full-time investor investing in the equity market, then obviously 20-22 stocks can be fine, because if you are a full-time investor, then you can obviously track 20 to 22 stocks. And remember, while I am saying tracking the stocks is very important, that's also a part of portfolio construction. Tracking doesn't necessarily mean just by looking at the stock price. Tracking means you need to track all the related news, all the industry news, if there is some management interview coming and not, and most importantly, quarterly result, if there is quarterly press release, quarterly investors presentation with annual report and all. So a lot of things related to the stocks, lot of news. It's not only talking about the looking at the stock price. So ultimately, as long as you can comfortably actively tracking your stocks, till then it's completely fine to hold that particular number of shares in your portfolio. And by saying diversification, you need to diversify among sectors. It's risky if you keep all the 10 stocks from your portfolio from a particular sector unless and until you are 100% sure about it. Sometimes what I noticed that after COVID-19, while many of the sectors were not recovering that much well, many of the sectors were in pressure back in April, May, June, July, August 2020 period, then maximum investors concentrated their portfolio on the defensive companies like pharma, FMCG, chemicals. So up to 2-3 sectors still fine, but again on that time also, if you say that okay, I'll concentrate only on pharma, that might be very risky. So at least divide your bet within 2-3 sectors. The more the sectors, the better. If it is not, then you can always diversify between 4-5 sectors and different kind of stocks from those sectors. The fourth important point of portfolio construction is always keep cash in hand for any sudden correction in the market. Okay, you might ask how much cash I should always keep. Before answering that, I have another little small thing for you. That is, if you like the video and if you want to keep similar free videos in my YouTube channel, make sure to subscribe my channel and keep sharing this video with your friends, because unless you share this video, the number of views won't increase, and you know very well that without enough views there is little incentive for publishing free videos in the YouTube. So I'll request you, if you like the video obviously, and if you want I'll keep publishing free videos in YouTube, make sure to share with your friends as many times as you can and subscribe this channel. Again, coming back to the point, always keep cash in your hand. How much cash? Well, I will suggest at least 10% of your portfolio value. At least that's the minimum. So if your overall portfolio value is say for 100 rupees, then you should always keep 10 rupees cash in hand. So similarly, if you have a portfolio value of 10 lakhs, always keep 1 lakh cash in hand. Cash in hand means cash in the bank account, in short time fixed deposit, or in the savings account, because nowadays few banks, like I know IDFC First Bank is currently offering a very high 6% kind of savings interest rate. So keep that amount in a liquid, be it saving account or be it liquid fund or wherever you want, so that within 1 day notice or within the same day notice you can invest in your stocks. 10% is the minimum. If you want to keep more, like for 20%, 25%, 30%, the higher can be the better. Why? Because you know, nobody knows what is going to happen in the market in the next week or in the next month. It might happen in the next week or in the next month, a sudden crash appears, maybe not related reason to the India, might something happened in USA or China or wherever in the world. Now if something like this happens, then what will happen? You know, many quality stocks also correct. Many of your, in your portfolio stocks, you will find many quality stocks price might correct, and you should utilize that opportunity to invest your cash, your reserve cash during that time. Unless you have the cash in hand, you can't obviously invest in the correction, right? And nobody can say when exactly the correction will occur. Correction occurs all on a sudden, be it in a bull market or what kind of market you term. All on a sudden the correction happens. Nobody can predict when and how much correction is going to happen. This is why for a prudent portfolio building, it's always necessary to keep at least 10% of your portfolio value in as cash in hand, so that for any correction you can invest, utilize that amount in quality stocks. If you can keep higher, 20%, 25%, 30%, that's even much better. The fifth important point, never build your equity portfolio with borrowed amount. Borrowed means any kind of borrowing, be it borrowing from banks, from friends, from parents, whatever, because stock market is always uncertain. Many investors think that once a new investor earn 20%, 30% return in a stock market for the first year, then it's see, oh, I can take a loan at 10% interest rate and then I'll invest that money into stock market. I'll earn that 20% and I'll have a 10% net profit without have my own money. But remember, leveraging is a very risky practice unless and until you are a very highly experienced investor or a high net worth investor. Because what happens, stock market is full of uncertainty. While it times to repay the money if somehow the market crash, and that happens multiple times. I have noticed it among many investors that while the requirement of money comes, the market is not that much supportive and they forced to sell a stock. Why taking a loan and investing is a risky practice? Because when you are taking a loan, it means you must have to repay at particular point of time. You don't have any time flexibility. So on that particular point of time, if a stock price drops down and you know that within few months the stock will recover, but you have no option but to book at that stock at loss. And if that happens, if you book at loss, then you will lose interest rate and also the loss. So never ever invest from your borrowed amount. Not only borrowed amount, if you keep any emergency fund, for any fund for your medical treatment or for your child education or for any kind of short-term goal, if you keep aside a particular fund, don't touch that fund, don't keep that fund in the equity investment, because it can be very risky. While it requires the fund, if market behaves anything, like if the market corrects small, little, high, whatever, then you will be in danger and you might be forced to sell your good quality stock. So the fifth important lesson, and remember, maximum people lose money from the stock market because many of the cases I have noticed that they borrowed money, maybe from market or from relatives or from parents, from wherever. So the fifth important lesson is never ever invest in the stock market with borrowed money. Now share your comments, which part you like the most and what's your experience about the portfolio construction. If you like the video, make sure to click on the like button and share the video and subscribe the channel. That's it as on today. Stay tuned for another insightful video. Happy investing.